First batch of big bank earnings out this morning, and the shares of CitiGroup are down about 3.5% despite second quarter earnings and revenue both coming in stronger than expected. Joining us now live from Citi's New York headquarters is Citi CFO Mark Mason. He's a member of CNBC's CFO Council, and our very own Leslie Picker is there with him. Leslie?
Thank you, John. And Mark, thank you so much. This is your CNBC debut, so a warm welcome.
Thank you.
Thank you so much for being here. Let's just start on the second quarter. You boosted your 2023 net interest income by about $1 billion. Deposits have been pretty stable, pricing incrementally rising. What's the outlook for the competitive dynamic on that front, and how long can these NII tailwinds really persist?
Well, Leslie, again, thank you for joining us here at headquarters. Let me start by saying we had a solid quarter here in the second quarter. We had revenues of $19.4 billion, net income of $2.9 billion, $1.33 per share. We returned capital in the quarter. So really solid performance that really reflected the diversification of our business model. You asked about NII. When I think about NII and Citi, I think about that diversification. I think about in our institutional client group, the services businesses, our Treasury and Trade Solutions business, our securities and services business. These businesses generated growth on the top line of 15% year over year, with a significant portion of that being net interest income. As we saw both the increase in interest rates, as well as we did more with our existing clients and brought on new clients. We don't just bring in their deposits. We're helping them to manage their liquidity. We're helping them to manage their working capital. We're helping them to manage their payments. And we do that for multinationals all over the world. What we're seeing in terms of NII growth and the prospect for more growth, that 45 growing to 46, which is X markets, is really about that continued momentum in both that TTS business, particularly with our clients outside of the U.S., but also on the consumer side with the growth in our cards volume activity. And those two things contributed to my updating the forecast for net interest income to $46 billion.
They're showing the stock price on the screen, down about 3.5%. Citi trading at less than half of book value at this point in time, quite cheap relative to peers. Part of the market's hesitation really has been kind of this wait-and-see approach around your transformation plan. There's uncertainty surrounding capital rules, economic uncertainty that's out there. How confident are you that the firm can just withstand these forces and boost the price from here?
Yeah, look, there is a lot of uncertainty that's out there. I am very confident. In fact, if you look at our Investor Day, we talked about a shift in our strategy, a focus on these 5 core businesses, and these businesses will contribute to continued top-line growth. Those services businesses that I mentioned, as well as the cards business, as well as continued strength in markets like fixed income, those businesses will contribute to that revenue growth in the future. The market's hesitancy is really around the investments that we've been making. And we have to make these investments. They're investments in transforming the operations of the organization, investments in modernizing the bank and shoring up our safety and soundness. These investments are occurring now as we execute on their implementation. And in the future, they will help to yield greater efficiencies and bring down our cost structure.
And of course, you're making these investments at a time where the economy is more resilient, I think, than a lot of people expected.
Yes.
Relative to expectations, you disclosed a pretty low reserve build, just about $300 million.
Yes.
CPI print coming in lighter than expected this week. At this point, do you think a hard landing is off the table?
Look, our base case calls for a mild recession at this point. We did have a good CPI print. I think the Feds are likely going to want to see a couple of more months of that before taking significant actions in a different direction. But when I think about our consumer, I think about the corporate clients, they have very strong balance sheets, and they've proven to be quite resilient through all of this. And so I think if there's ever a chance for a soft landing on this, I think these indicators are certainly suggesting that. I think importantly, we Citi have been there for our clients regardless of how this turns out, and we'll continue to be there for them.
What about the broader banking industry? Do you think the banking crisis is over at this point in time?
Look, what I'd say about the banking industry is that we are significantly stronger than we were at the last global financial crisis. All the banks. I think the large banks have built a significant amount of capital, and if I think about what happened in the last quarter, I'm proud that we collectively and individually as a firm were there to help support the banking industry and the broader financial market. There are obviously some uncertainties out there in terms of capital headwinds. We'll manage those. We all passed the recent stress tests. Obviously, the Basel III endgame is still under consideration. Our proposal is still forthcoming. And as that comes out, we'll manage that. But the industry as a whole, I think, is very strong. And I know Citi is very strong, both capital, liquidity, our interest rate management, et cetera.
Yeah, I think you could tell from the conference call with analysts that, given where your stock price is trading, there's a hope that eventually you'll be able to do more buybacks.
Yeah.
You say you're evaluating on a quarter-by-quarter basis. How long should we be kind of waiting to see that number tick up and accelerate?
Look, what's important here, and Jane and I have been very clear about this, we obviously are in a business for supporting our clients. We also want to make sure that our shareholders benefit from the work that we do, and that means more capital actions. If you think about what we did in the second quarter, we did capital actions of $2 billion. About $1 billion in repurchases as well as dividends. We also announced an increase in our dividends from 51 cents a share to 53 cents a share. So we are focused on opportunities to return more capital. We want to be responsible as it relates to that. We talked about some of the pending capital requirement changes. We need to factor those in. We need to consider those. But importantly, the strategy that I referenced to you earlier is designed for us to improve our return on and our return of capital. And that's what we're going to do.